Welcome back to another episode of Market Brief After Hours. It's been a week that I think a lot of investors are going to want to forget, or at least study very closely, to figure out what went wrong. We closed out February not with a bang, but with a pretty significant slide.
That is putting it mildly. It really felt like the market got hit from all sides this week. You had the inflation data, which was the main headline, but then underneath that, you had this growing anxiety about artificial intelligence, stress in private credit, and even some cracks appearing in the labor market. It was a perfect storm for a sell-off.
Let's start with the big picture, the inflation shock, as the headlines are calling it. What exactly happened to the major U.S. indices? And for our listeners tracking the levels, let's get those specific closing numbers.
Right, so the damage was broad. The Dow Jones Industrial Average took a serious hit, sliding sharply. It fell about 1.05% to close at 48,978. That drop was largely driven by financials and those economically sensitive sectors that just hate the idea of higher rates.
And the S&P 500?
It wasn't spared either. The S&P 500 dipped 0.43% on Friday, settling at 6,879. That move actually sealed a monthly loss of close to 1% for February. It's interesting because for a while it looked like the S&P might hold up, but the weight of the tech and financial sectors just dragged it down.
Speaking of tech, the Nasdaq usually takes it on the chin when interest rate fears pop up. How did it fare?
It was the worst performer of the bunch. The Nasdaq Composite slid 0.92% to finish at 22,668. That caps off its weakest month since last March, down more than 3% for February. When you look at the software and semiconductor names, they were just heavy. The iShares Expanded Tech Software ETF, for example, was down nearly 10% for the month. That is a massive correction in a short amount of time.
So the catalyst here was the Producer Price Index, or PPI. We were expecting a bump, but this was more of a surge, wasn't it?
Exactly. This was the hot reading that spooked everyone. Core U.S. producer prices jumped 0.8% in January. The market was expecting 0.3%. That is a huge miss. And headline PPI was up 0.5%. The problem is that this was driven by services prices, which tends to mean that inflation is getting sticky. It's embedded. And if inflation is embedded, the Federal Reserve can't cut rates.
And the bond market reacted immediately to that.
It did. We saw Treasury yields falling below key levels, which sounds counterintuitive when inflation is high, but it's actually signaling stagflation fears, slowing growth with high inflation. The 10-year yield fell below 4% to 3.962%. The market is worried the Fed is going to be stuck between a rock and a hard place.
Let's look across the Atlantic. European markets seemed a bit more mixed. It wasn't a straight sell-off everywhere.
No, it was a bit of a tug-of-war in Europe. You had earnings competing with economic data. The Pan-European Stock 600 actually edged about 0.2% higher, but when you break it down by country, you see the divergence. London's FTSE 100 was the standout, rising 0.75% to 10,928. They have a lot of defensive and commodity-linked stocks, which helps when risk appetite fades.
And the rest of the continent?
Germany's DAX managed a small gain of 0.16%. But France's CAC 40 slipped 0.5%, pulling back from record levels. Italy's FTSE MIB was down 0.4% to 47,210, dragged down by banks. The data out of Europe isn't great either. German unemployment rose slightly, and French inflation accelerated to 1.1%, which was well above expectations. So the sticky inflation narrative isn't just a U.S. problem. It's happening in the Eurozone too.
Moving over to Asia, we saw some spillover from the U.S. tech weakness, specifically regarding Nvidia. How did that play out in the region?
It was uneven. Japan is still seeing some strength, with the Nikkei 225 rising 0.16% to 38,850, and the broader topics actually surging 1.5% to 3,939. But South Korea took a hit. The Kospi declined 1.0% to 2,644. That's largely because of the tech exposure. You saw SK Hynix down over 3% and Samsung down as well. When Wall Street catches a cold on AI doubts, Asian tech manufacturers sneeze.
Before we get into the commodities and the individual stock movers, I want to touch on crypto. Usually when stocks fall, crypto has been trading somewhat correlated to risk assets. Did that hold troops?
Absolutely. Risk appetite faded and crypto slid right along with it. Bitcoin fell back to $65,685, which erased its late February gains. It ended the month down nearly 16.75%. Ethereum dropped 4%, and altcoins like Solana and Dogecoin saw losses anywhere from 5% to 18%. It was a classic risk-off move.
We're going to take a quick break. When we come back, we'll dive into the Forex markets, specifically looking at those moving averages, and we'll break down the biggest winners and losers in the stock market this week. Stay with us. Welcome back to Market Brief After Hours. We've covered the indices and the macro picture. Now, let's get technical. The currency markets were active, and I know a lot of our listeners watch the technical levels closely. Let's start with the euro against the dollar.
The Euro USD actually had a constructive week. It closed at 1.1816, up 0.16%. The key here is the moving averages. The pair held firmly above the 50-day moving average, which is sitting at 1.1777. The 100-day is at 1.1694, and the 200-day is at 1.1662. Since the price is above all of these, the broader structure is bullish. It's making higher highs and higher lows.
So the bulls are in control there. What about the British pound?
That's a different story. GBP USD slipped back, closing at 1.3479. It's in a consolidation phase. Crucially, it finished below the 50-day moving average of 1.3539. However, it's holding just above the 200-day average at 1.3448. That area between 1.3440 and 1.3540 is a real battleground right now. If it breaks below that 200-day support, we could see a deeper drop toward the 100-day average at 1.3396.
And the Swiss franc.
USD CHF is in a clearly established downtrend. It fell sharply to close at 0.7688. It is trading well below all the key averages. The 50-day is at 0.7827, the 100-day at 0.7916, and the 200-day at 0.7979. All those averages are sloping lower. Every time it tries to rebound to that 0.7800 area, it fails. The bears are definitely driving the bus on this one.
Let's shift gears to commodities. While stocks were struggling, precious metals seemed to be having a party.
A massive party. Gold extended a sharp rally, closing at $5,262. That's up 1.57%. It's firmly above all its moving averages, 50, 100, and 200-day, which are famming higher. It's a strong bullish alignment. But the real star was silver.
I saw that chart. It went vertical.
It really did. Silver surged 6.24% to settle at $93.75. It's a breakout move. It's holding well above its 50-day average at $83.42. When you see a move of that size closing near the highs, it tells you there is aggressive demand. It looks like the market is pushing toward that psychological $100 level.
And oil? With the geopolitical tension, I assume it was up?
Yes, crude prices rose more than 2%. The U.S.-Iran nuclear talks extended, which always makes the market nervous about supply. Brent crude settled at $72.48, and U.S. WTI closed at $67.14.
Okay, let's talk about the individual companies, the market movers. Despite the gloom in the broader market, there were some massive winners. Let's start with Block.
Block was a huge standout. The stock soared 16%. They reported fourth-quarter results that beat expectations. But the other side of that coin is that they announced they are reducing their workforce by over 4,000 positions. The market often rewards efficiency and cost-cutting, and that's what we saw here.
And Dell Technologies?
Another big win. Dell rallied 22%. They had a robust financial report where both revenue and adjusted earnings beat estimates. It shows that even with the tech wobble, there is demand for hardware.
What about Dentsply Sirona? That's not a name we talk about every week.
No, but they had a great week. The dental products manufacturer jumped 15%. Their quarterly revenue topped forecasts, and they unveiled a restructuring plan. Again, investors love a good restructuring story right now.
Now we have to look at the other side of the ledger. Who took a beating?
Well, Sunrun collapsed. There's no other word for it. Shares plummeted nearly 35%. Investors reacted very negatively to their cash generation forecast for the upcoming year. In this high-rate environment, if your cash flow outlook is weak, you get punished.
And in the cybersecurity space, Zscaler had a rough time.
They tumbled 12%. The issue was their billings data. Deferred revenue and billings for the second quarter missed expectations. In SaaS stocks, billings are a leading indicator of future growth, so a miss there is taken very seriously.
We touched on the AI anxiety earlier. Nvidia and CoreWeave were in the crosshairs.
Yes, Nvidia, the leader of the AI rally, fell 4% on Friday. Investors are starting to question the long-term sustainability of the capital expenditures by cloud providers, basically asking, is all this spending going to pay off? And CoreWeave, a specialized cloud provider, dropped 18% after their financial outlook fell short. It shows that the buy anything AI trade is shifting to show me the money.
It feels like the sentiment has really shifted in just a few days. We went from soft landing hopes to sticky inflation and tech doubts.
That's the perfect summary. February ended on very uneasy footing. We have stubborn inflation, uncertainty about Fed policy, and now doubts about the biggest growth driver in the market, AI. As we head into March, investor sentiment is fragile. The market is grappling with crosscurrents, and I think volatility is going to be the name of the game for the next few weeks.
Well, we will be here to track it all. That wraps up this edition. If you find this useful, please follow Market Brief After Hours. We'll see you next week.